Hi guys. Today we will analyze Verizon stock, and calculate its intrinsic value using two different valuation models. Enjoy! Hit the like button and subscribe to my channel if you want to see more videos like this. Technical analysis. Verizon's overall performance in the market is below average. The short-term trend is negative, the long-term trend is neutral. The stock has been moving sideways between $44 and $62 since 2013. Not much exciting going on here. Support levels are around $50 and $48. The next support levels are around $46 and $44. Resistance levels are around $53 and $55. The next resistance levels are around $56 and $58. In the last month the stock has been trading between $50.80 and $55.40 range. It is currently trading near the lows of this range. The stock has an average volume of 22 million. This is a good sign as it is always nice to have a liquid stock. The stock is currently trading in the lower part of its 52-week range, which is not a good signal. Intrinsic value. Buy low, sell high. We have heard it many times before. But how to know when it's low, and when it's high? The intrinsic value of a stock is its true value. It refers to what a stock is actually worth, even if some investors think it's worth a lot more than that amount. Intrinsic value is important, because it can help investors understand whether the cost of a stock is undervalued, or overvalued compared to the market value of the stock. Let's calculate the stock's intrinsic value. For more accurate results, we will use two different valuation models to calculate the intrinsic value of the stock. Discounted free cash flow model, using the formula below, then, valuation based on earnings per share, 5-year average P/E ratio and expected growth rate. First model. Discounted free cash flow valuation. This spreadsheet contains some financial data that we will use for the stock valuation. We see that the average revenue growth rate of the stock has been around 1% per year, for last 5 years. We see that the average profit margin of the stock has been around 16% per year, for last 5 years. Also we see that the average free cash flow to net income rate of the stock has been around 90% per year, for last 5 years. And we expect 8% per year average stock market return. Now, let's consider 3 different scenarios for Verizon Company: bad, average, and good. First scenario. Verizon will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be a low, 0%. Future profit margin would be a low, 12%. Future free cash flow to net income rate would be a low, 50%. In this case, the fair value of the stock today would be $58. Second scenario. Verizon will have average performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be average, 1%. Future profit margin would be average, 13%. Future free cash flow to net income rate would be average, 60%. In this case, the fair value of the stock today would be $77. Third scenario. Verizon will have high performance in next 5 years, and we will use the following parameters in our calculation. Future revenue growth rate would be high, 2%. Future profit margin would be high, 15%. Future free cash flow to net income rate would be high, 70%. In this case, the fair value of the stock today would be $107. Second model. Valuation based on earnings per share. This spreadsheet contains another financial data that we will use for the stock valuation. The current earning per share price for the company is 5.32. Minimum rate of return. I will use 12%. Because when we invest in individual stocks, we are looking for a higher return than the S&P 500. For Verizon, analysts forecast growth rate around 2% per year in next 5 years, and future P/E around 10. Again, I will use 3 different scenarios for Verizon Company: bad, average, and good. First scenario. Verizon will have bad performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be a low, 0%. Future P/E would be a low, 11. In this case, the fair value of the stock today would be $21. Second scenario. Verizon will have average performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be average, 1%. Future PE would be average, 13. In this case, the fair value of the stock today would be $27. Third scenario. Verizon will have high performance in next 5 years, and we will use the following parameters in our calculation. Future growth rate would be high, 2%. Future PE would be high, 15. In this case, the fair value of the stock today would be $34. As you can see, today the stock is overvalued, $51, even if we expect the company's high performance in future. There are some concerns on Verizon's financial health and future growth. While showing a very small growth rate, I wish the stock would be cheaper. But given that the stock has not been lower $45 since 2017, I doubt the stock will drop lower $45 anytime soon. Based on Verizon's high debt level and small growth, my buy price for the stock would be $45. Keep in mind that the stock may trade sideways for years. So, I need an extra margin of safety with Verizon. However, if you are close to retirement, you may like the stock at these levels. With a yearly dividend yield of 5%, Verizon is a good candidate for dividend investing even at $50. Company's strengths. Verizon is a leader in the U.S. telecommunications industry. Growth in wireless and FIOS broadband are driving sustainable growth at Verizon, while the business segment continues to weigh on results. The company should return to normality after the disruptive ups and downs of the pandemic as the company added over 1 million postpaid subscribers. Also, Verizon announced the launch of its next-generation 5G Ultrawide Band network services. Verizon continues to rely on its superior network quality as a primary differentiator in the market. Verizon continues to successfully execute on its subscriber acquisition strategy with a focus on protecting its high-value postpaid subscriber base and enticing lower-value subscribers to upgrade. At the same time, it is also making a play in prepaid with its recent acquisition of TracFone. With a yearly dividend yield of 5.04%, Verizon is a good candidate for dividend investing. Verizon has a return on assets of 6%. This is better than the industry average of 3.6%. Verizon has a return on equity of 27%. This is better than the industry average of 12%. Its profit margin of 16% is amongst the best in the industry. Risks. Verizon has been the leader in next-generation wireless technology, but may be playing more of a catch-up game with 5G as T-Mobile forges ahead. Verizon will continue to struggle with competition in the wireless space, and its heavy spending on the C-band auction will drive up debt levels. In 2022 the company will likely continue to lose market share to T-Mobile and that debt levels will continue to rise. Telecom companies are highly susceptible to disruptive technological change. Verizon's businesses are also highly regulated and dependent on a benign regulatory environment. The B and C block spectrum is not required to be cleared until the end of 2023, which means Verizon may have a long wait on its hands before it can deploy more C-band spectrum. Ongoing wireline declines and video losses from cord cutters. Verizon is not financially healthy enough and could expect problems in meeting its short-term obligations. Verizon's net debt-to-equity ratio, 180%, is considered high. Based on estimates for the next 5 years, Verizon will show a very small growth in revenue and EPS. The revenue will grow only by 1 to 2% on average per year. In the coming 5 years, the earnings per share will grow only by 2 to 3% yearly. Thank you for watching. If you found this video helpful, please hit the like button and subscribe to my channel.